Fiverr released their earnings today, and it looks like I may have been onto something. I'm going to give you my updated thoughts, take you through some of the shareholder letter, and we'll look at some of the results. If you haven't watched that video where I gave my full valuation of Fiverr just recently, please go watch it. I'm going to link it in the description. This is meant to be a follow-up to that. I give a lot of perspective in that video, and I'm not going to rehash it all here. I really just want to give an update on my perspective after earnings. So go watch that first valuation and then come back and check this video out after that. Welcome to the Stock Sale Flyer. My name is Aaron. None of this is financial advice. Let's go ahead and get into it. The market seemed to really like the Fiverr earnings today, up 10.29% at the close. Really strong day for Fiverr coming off of earnings. And so I thought it made sense to go in and take a look at some of the things that came out of the earnings report and the shareholder letter. So you can see here they delivered revenue at the top end of their guidance. They had spend per buyer grow 8% year over year. They said that's the strongest growth in more than a year. And they noted the share repurchase program that I mentioned in my video that I recorded a couple days ago. They said they're on track to deliver 2024 guidance. They raised the low end of their guidance for both revenue and adjusted EBITDA. So definitely seems like things are on the right track. And I think the market's response today really shows that there is quite a bit to be optimistic about here. You look at some of these first quarter key results, revenue, 6% year over year growth. Active buyers did decrease by about 6%. As we go through these earnings, you're going to see some references, Fiverr talking about looking for clients with bigger budgets and things like that, focusing on clients that spend more than maybe some of the smaller clients. So I think this is what they're saying. I don't know if it's just to justify the numbers or if they're really focused to appeal to more buyers with big budgets, but the numbers do seem to follow what they're saying there, if that is the case. So active buyers down 6% year over year, but spend per buyer up 8% year over year. And their take rate improved again, 190 basis points year over year improvement in take rate. I said in my video the other day, gross margin is something that I really like about Fiverr. You see that's still really strong. GAAP net income still being dragged down by share-based compensation, probably some other factors too, but the share-based compensation that I talked about in my video the other day, as you'll see here in the numbers, is still something that I'd like to see not drag net income down so much as we go forward. I'd like to see them rely less on share-based compensation. But again, they noted that share repurchase program, and so I'm really looking at that as a sign that maybe they're going to try to offset some of the dilution that's affecting the earnings per share numbers. Hopefully, go in the other direction and actually buy back shares and not have your shares outstanding increasing, but actually decreasing. This is an interesting company because they do cash flow, but their net income numbers, because of the share-based compensation, and again, probably some other things, but the share-based compensation is a big factor here, really drags those net income margins overall. So I'd like to see that improve. Financial outlook, you can see here, I've highlighted how they've raised the low end of those revenue and adjusted EBITDA estimates. And you can see the prior guidance in kind of grayed out here off to the side. So this note in the shareholder letter reflects the idea of them going after buyers with larger budgets. So going up market, we continue to make progress in attracting customers with larger wallet shares as we focus on our upmarket efforts and expanding complex services across our marketplace platform. Obviously, they'd probably like to have as many customers as they can. I don't know, but I would assume that. But them saying they're focusing on clients with bigger budgets, maybe that is a focus for the business and kind of goes away from the original idea, in my opinion, of offering freelance services for as little as $5, because that would seem to appeal to smaller buyers. But maybe they see this as more of a growth, avenue for the business. And so it seems that maybe that's the direction that they're headed. Here you can see GAAP net income was $0.8 million compared to a loss of $4.3 million in Q1 23. So even though this GAAP net income is still not where I would like it to be, in large part because of that share-based compensation, I do like that they are profitable on a GAAP basis. And that is a big improvement from a year ago. So that is good to see. Revenue was up 6.3% year over year. and they said this is driven largely from spend per buyer. They noted that the year-over-year growth rate also benefited from the increase in their take rate, which does show, I think, some moat for the business that they are able to raise their take rate like they have. Here under active buyers, they make the point to say we accelerated the pace of our upmarket efforts and shifted our acquisition budget toward higher value buyers while reducing investments in channels that mostly attracted low value customers. We continue to focus on higher lifetime value by targeting buyers with larger budgets, benefiting spend per buyer more than active buyers. Again, noting this, they're trying to say, hey, we're focused on these bigger buyers. And so we are seeing a decline in the total number of buyers on the platform, but the spend per buyer is increasing. Is that their strategy, or are they just trying to give a justification for the decline in the number of buyers on the platform? I don't know. They are growing revenues, so I'm not really overly concerned about it. I don't like it that they have fewer buyers on the platform, but I'm not overly concerned about it because they're growing revenues and it seems like the business is headed in the right direction overall. Here you can see that gross margin was 83.5%, which is an increase of 130 basis points from the prior year. I've said the gross margin is something I like about the business that I think shows that it has a lot of potential because they can maintain such a high gross margin. And that's only going to benefit the business, I think, as it matures, as long as they can maintain that margin. Another note here about the GAAP net income and then the adjusted EBITDA. Adjusted EBITDA was $16 million or 17.1% of revenue in Q1 24 compared to $11.3 million or 12.8% in Q1 23. So solid growth, it looks like there. Adjusted EBITDA, I don't always, it's not my favorite thing to always look at, but it is worthwhile to look at it and then to sometimes look at the reconciliations between things like GAAP net income and adjusted EBITDA. Here in the consolidated statements of operations, you can see that they are profitable, just 2 cents a share for the diluted net income per share attributable to ordinary shareholders. I am hoping to see that number increase as we go through the fiscal year, and I'm hoping to see some of those buybacks come in, which will allow the net income per share, the diluted GAAP net income per share, to improve as you have fewer shares outstanding, assuming they do buy back shares as a part of that buyback program that the board authorized. I noted here on the consolidated statements of cash flows that the cash flow growth looks solid. You can see here the difference between the 3 months ended March 31st for 2023 versus 2024. You can see the net cash provided by operating activities, the growth in that, and then you can see the capital expenditures noted down here. And if you subtract your capital expenditures, I've highlighted the purchase of property and equipment and the capitalization of internal use software and other. You subtract those numbers from your net cash provided by operating activities, and you can see the free cash flow for the business. And so free cash flow is growing here on a year-over-year basis, which is a positive. Here on the reconciliation of GAAP net income to non-GAAP net income and net income per share, you can see the share-based compensation is still quite high. And just like I mentioned in my valuation video that came out just recently, this is really a big drag on net income from a GAAP perspective for the company. So I'm really hoping to see them move more away from share-based compensation as the business matures more. And if they can do that, you're going to see a better GAAP net income number. But for now, this remains something that is dragging down their GAAP net income. The business continues to cash flow. And so I'm hoping that GAAP net income will come more in line with the cash flow numbers, the free cash flow numbers, I should say, as the business matures. That's really a big part of my thesis for this investment. All right, so here I went back into the valuation. I didn't change a whole lot. I think a lot of what I saw from the earnings was really in line with what I said in my valuation video. If you haven't watched the full valuation video, please go watch that. It has a lot more perspective about some of these topics. This is really just an update for after earnings. You can see that the fair value of equity didn't change very much from that. I just updated a few things like the beta, the 10-year bond rate, the market cap. I changed the shares outstanding to have it be based on the diluted weighted average shares from the shareholder letter that they just released. The revenue numbers, are, I believe, the same as they were the other day. I checked ticker and the analyst estimates hadn't changed any, so I left those as they were. The free cash flow estimates, I believe, remain the same. And I left the net income numbers alone for this as well. I'm a little bit skeptical that they're going to hit some of these numbers for net income and free cash flow. But with some of the positives and some of the growth that I am seeing in the business, I didn't dare to downgrade those either. So it's one of those things where I just would want more of a margin of safety for me personally, because I'm a little bit skeptical if they can hit these numbers, but I wouldn't be surprised if they did. And that's really why I didn't want to be overly pessimistic either and go away from these. And so really, because I could see them hit these numbers, I didn't really want to go away from what the analyst said for free cash flow here or my prior estimates for net income. To figure this out, by the way, I took the GAAP EPS numbers from ticker and then multiplied them by, I think it was the shares outstanding, not the diluted ones, the non-diluted ones. So I used the non-diluted share number. I didn't change this for this valuation because if I did, it would have made these net income numbers go up higher because there are more shares outstanding than there were from the I think it's a 20F, the annual report for Fiverr. So I left those net income numbers alone from the last valuation that I just put out because I didn't really see the point in changing them. There's nothing that dramatically different going on here. If anything, I think that the earnings were positive. I mean, they raised the lower end of their guidance in revenue and adjusted EBITDA. So I liked the earnings. I thought they were good. I didn't see a reason to go away from these. But just again, the point being, I would, for me, want a good margin of safety on this because I'm a little bit unsure about whether they'll hit these free cash flow numbers, whether they'll hit these net income numbers. I do think as you go further out, as you get to after the 2028 fiscal year, that this is actually more likely and could even be a little bit pessimistic because I could see their net income margin being above 10% at that point as the share-based compensation hopefully becomes less of a drag on their net income. That could really happen quickly. So it's one of those things where it's tough to judge when is that change in share-based compensation going to really happen. When it does happen, when you see them rely less on their share-based compensation, you're going to see the net income, I believe, improve quickly. And as they buy back shares, you're going to see the earnings per shares numbers improve, obviously, depending on how many they buy back. So again, didn't want to change a whole lot, but did want to give you an update on my thoughts about the earnings. I thought that they were really solid. I think the market agrees with me, and that's why the stock was up over 10% today. I still think there's meat on this one. It's not a one-day pop. I think that there's room for this stock to run. Not financial advice, just my opinion. And I think that this is one to continue to keep an eye on. Thanks again for joining me today. Hope you got something out of it. Please like, subscribe, and click the bell. Also, follow me on X at Stock Sale Flyer if you haven't done that yet. Love to talk to you over there. As always, take care, and I'll see you next time.